The Consumer Bankers Association is pleased to welcome you to today's webinar, How Essential Analytics Can Drive an Effective Deposit Strategy, presented by Curinos. My name is Isabella and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include Q&A opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to hand it off to our speakers, Agusta, Brad, Adam, and Ravi. Welcome.
Thanks so much, Isabella. And I'll just give a little background on our team here. I'm Adam Stockton. I oversee all of our retail deposit and lending businesses. I'm joined by an awesome team today. Agusta Patton, who oversees our client solutions division, responsible for implementing and helping our clients get value out of all of the tools that we provide. Brad Resnick looks after a number of our solutions on the retail side. And Ravi Subbaraya, who has joined us recently as a senior leader in the consumer deposits area, brings a wealth of industry experience, and you'll be hearing from all of us as the presentation goes on today. So today we'll be going through just what we're seeing right now in the market, some current trends, and then really spend the bulk of our time focusing on what is it going to take to win in this unusual environment. We're at an inflection point where rates are poised to drop from a point this high for the first time in more than 15 years. We still have after effects of inflation and uncertain macroeconomic times ahead. So how do you do that, and what are the essential analytics that you need to take you through the journey? As Isabella noted, please do ask questions at any point through the presentation today. Put them in the Q&A box on your screen, and we'll answer them as we go through the presentation. So what are we seeing in the market right now? First off, consumer deposits continued to run off in 2023. After completely ahistoric growth in 2020, the surge deposits held on a lot longer than anybody expected through 21, and then in the second half of 22 really began to run off. We have seen some stabilization, but after kind of you can see all the way back to 2012, consumer deposits used to be remarkably stable, and we're still not back to those levels yet. One way of looking at this, though, is not just at the total system level, but actually at the customer level. One of the big impacts has been the rising effects of inflation and how that's impacted the consumer wallet, with the cost of goods and services continuing to go up. That has put a dent in the cushion of savings that many consumers have been able to build over the last few years. What this graph looks at is a monthly average customer balance across all deposit products held at a bank. This data all comes from our deposit analyzer product, with over 40 banks and credit unions providing account level data on a weekly and monthly basis. So these are kind of true account holdings at a customer level. And what we've done is we've taken 2015 to 2020, right before the onset of COVID, and then we've smoothed out that trend line. So the blue dashed line on the right-hand side says, all right, what if we continue to grow the average customer balance at that same 2015 to 2020 pace? You can see through the pandemic with EIP checks, foregone spending, we got well above that line by more than $2,000 for a pretty significant period of time. Really starting in 22, that average balance line started to move back towards the trajectory from before COVID, and we've now reached it. That seems to suggest to us that some of that we may be getting back into the territory where that excess cushion is gone. That augurs some potentially good things in terms of continued deposit growth if there isn't the excess to spend. It also is potentially warning signs in terms of credit and charge-offs at the bottom end, where consumers who don't and never had the cushion need to spend through it. One of the other big things that we look at is huge differences by type of bank. So you can see for the year last year, industry-wide consumer deposits were down just under 1%. But the first thing to note is substantial disparity between traditional branch-based banks and direct banks. Traditional branch banks and credit unions were down right around 3% for the year in terms of deposits, while direct banks, so online banks, internet banks, were up almost 8 points. That's after a year in 2022 of 14% growth for those direct banks, which are now well over $1 trillion of consumer deposits, and continuing to drive a lot of growth for the industry. Meanwhile, the top four national banks, Chase, Bank of America, Citi, and Wells Fargo, were actually down substantially more than the average traditional branch bank. This has been an environment where actually a lot of regional and community banks, have been growing deposits, even in an environment where the national banks are shrinking from a deposit perspective. And we'll talk a little bit more as we go on, about how small and smaller and community banks and credit unions are looking different than the overall averages here. We did get a question coming in. Do these numbers take inflation and wage growth into account? They do. So all of these figures on the last two pages are a deposit view that fundamentally incorporate inflation and wage growth. We do work in many cases, and as we move into the forecasting section coming up later, we'll talk about the importance of pulling some of those pieces apart and making sure you're accounting for those impacts, just because those forces are working in different ways than we've seen at any point in the last 10 years. But the deposit figures here kind of include all of those different factors working simultaneously. When we look at the traditional banks overall, we see also huge dispersion. So that we took the banks contributing data to our deposit analyzer product and just broke them out into 4 equal quartiles based on growth last year. So you can see here that the fastest growing banks grew almost at that direct bank level, 7.5 points for the year. Whereas the bottom quarter of banks, the slowest growing quarter of banks, looked a lot more like the national banks in terms of seeing more significant deposit runoff. Agusta, as you've been working with a lot of mid-size and community banks in particular, was hoping maybe you could share a little bit on what the trends look like in the mid-size and community space.
Yeah, for sure. So if you wanted to go to the next page, I might get at some of the biggest trend differentials that we're seeing. So in general, small banks, the smaller mid-tier and community banks, are seeing higher acquisition and portfolio rates than their larger counterparts, and that gap is really growing over time. There's 2 primary reasons for this. The first one is around term products. So smaller institutions have been more heavily reliant on term products during this rising rate environment, and therefore they're making up a bigger proportion of the book. So I think it's close to 30% of smaller institutions' portfolios are term-based. That's lower than 20% for the larger institutions. So there's the portfolio makeup piece. The other flip side of the term piece is that the smaller institutions are paying more for those term products in general. So I think close to 90% of the acquisition in term products for the smaller institutions are above 5% over the past couple months. And that's closer to 70% on the larger institutions. That's the term side. On the liquid side of things, small banks are paying more for acquisition within savings and money market accounts. That's less due to higher headline rates, and honestly more due to the fact that the larger institutions are still bringing in significant amounts of acquisition, under 10 basis points, which smaller institutions just haven't been able to do that as much. So those are the sort of two primary drivers of the differences in the betas between the bank sizes.
Thanks, Agusta. Question came in here. Have we seen examples of smaller institutions who are able to see that level of growth, but get it a little bit more efficiently than some of the figures we're seeing here? And how have they done that?
Yeah, absolutely. It's definitely possible. We are seeing it. And the answer is to be smart about where you're pricing for your top of market rate. So are you pricing competitively enough to clear the market, but not so competitively that you are creating a unprofitable situation when those term products come up for maturity, and then being smart as they do come up for maturity. So I think we'll talk about this a little bit in the winning strategies, but are you really focusing on those term maturities and have a smart pricing plan in place for those? That's really the name of the game here.
Great. Thanks, Agusta. And I saw another question came in asking about direct banks. We use direct bank interchangeably with internet bank. So these are kind of the biggest ones are the Ally, Marcus of the world that don't have a physical branch presence and are taking their deposits solely virtually, direct to consumer, rather than through a branch network. So in an environment like this, what are the most critical pieces of a winning deposit strategy, and what are the essential analytics that you need to support those? Number one is forecasting. The entire forecasting ecosystem has had to get more adaptable over the last few years as we've seen, really unprecedented changes. You have to be thinking about scenario planning moving forward, given uncertainty. Forecasts have to take into account both macroeconomic variables as well as micro variables around, meaning how are you pricing? What are your competitive conditions in each market? Number two is preparing for CD maturities, which are already starting to hit a number of financial institutions. But understanding the renewal trends, what's coming up for maturity within your bank. What were the characteristics of those CDs when they were first brought on the book? Were they acquired top of market or not? Are they single service customers, more price sensitive? And then ultimately moving to, if you can identify the money that's likely to leave, it gives you a lot more optionality in terms of dealing with it. The third is starting to think through a falling rate environment strategy. Really important to understand your flow of funds and plan for different flows as we think about the market moving back from a CD dominated market to a more balanced CD and savings money market environment. avoiding repricing the back book remains critical as you think about retention and reacquisition. The next frontier here is really going to be personalization, which we've started to see a whole lot more of over the last 2 years, and is going to be where the industry goes over the next couple of years. Agusta, one of the questions we often get, or at least I do, and since most of the banks that I've worked with are larger banks, how do these strategies and analytics differ for mid-size and community institutions, or do they?
Yeah, the answer is it's similar fundamentals at the end of the day. I'd say one important way that it does differ, especially when forecasting for the uncertain environment, this first one, a lot of smaller institutions that we work with really want to stay focused on how's their forecasting looking in the context of their other small competitors in their geographies. And while that's incredibly important, we also find it's important to keep the overall industry and what's happening there from a forecast perspective in that context as well. Both are really critical to understanding how your performance plays into what's happening in the larger environment. So not just trying not to keep blinders on for your community, and making sure you are keeping the context of the larger environment. Obviously, the prepping for CD maturities for small banks is probably like number one priority of everyone that I'm talking to. It's a huge portion of the book of those institutions. And it's a muscle that a lot of folks haven't used in a number of years. So how are we thinking about maturities? What's my renewal rate likely to be at a given offer at maturity? How should I think about that? What's the elasticity, right? If I price up or down 50 basis points, what's my renewal rate likely to be? So having those analytics are really the key to whether you're succeeding or not in this environment.
Thank you. So we'll walk through the details on each of these now. I'll bring us through the forecasting section, and then Ravi will walk us through CD maturities and the falling rate strategy. So number one, just wanted to start with the continued uncertainty. And as we think about forecasting, the one certainty with any forecast is that it will be wrong. A broken clock might be right twice a day, but anyone looking to forecast exactly how this year or next year is going to go from a deposit perspective, can't get it 100% right with exact precision. Looking back to the rising rate environment, part of the reason I brought back this blast from the past is how quickly market expectations shifted from only one increase to ending the peak of the environment at 350 basis points, and even that was wrong. We ended up at 500. The market continuously underestimated the extent to which the Fed was going to go up. The expectations for the way down have continued to shift. The Fed came out and said probably 3 decreases this year. Pretty quickly, the market was up to 6 or more. It's now moderated a little bit. But as every latest set of inflation numbers, wage growth numbers, GDP numbers comes out, expectations are going to continue to shift. The unfortunate thing from a forecasting perspective is all these variables have a huge impact on what your forecast is going to look like. And so, how do you think about playing in against this uncertainty? The number one way from our perspective is, by looking at a few different scenarios. You need to be thinking about what does happen if the Fed only goes down 3 times versus 6 times this year, and how do you respond in each of those cases? Additionally, accounting for both macroeconomic and more micro variables is really critical. That can even filter out in different ways in different parts of your portfolio. So on the left-hand side, we're looking at lower balance checking accounts, excuse me, correlated with the core inflation rate. And you can see as inflation went up, the balance growth in the lower balance checking accounts slowed, stopped, and then started to fall. On the other hand, on the right hand side, the higher balance accounts are much more strongly correlated with the macroeconomic rate environment. When rates are high, it doesn't make logical sense to hold more than $25,000 in your checking account. We saw a huge proportion of checking accounts, so 40% of checking balances before rates started to rise in 2022 were held in accounts with more than $100,000 in them. As you could get 3%, 4%, 5% rates, a lot of that excess money flowed out into high yield savings and CD accounts to be taking advantage of those rates. And so kind of making sure that you're accounting for the impact of all of these different macroeconomic factors is important, and fundamentally not where most banks were historically from a forecasting perspective. I would say a majority of banks that we work with, prior to 2020, the forecasting process more or less went, hey, retail deposits are going to go up somewhere between 4 and 6%. We're aiming for 5% or 6%. We want to be in the middle, or we want to be at the top of that range. So we're going to take last year's monthly numbers and bump them up by 5%. That worked in an environment where, for a decade, everybody grew at the same level. It's not going to work anymore in a much more complex environment. So putting this all together, where do we see things going? We'll put our stake in the ground and put our kind of baseline forecast out there. We do see consumer deposits returning to growth overall this year. Not back to the levels that we've seen them in the past. So, as I noted, 4 to 7% was the historical norm. We're only looking at 0 to 3. Importantly, this is total consumer deposits, with the direct banks, the internet banks, now making up close to 20% of the market. The growth is still going to be tilted in that direction. If total consumer deposits are growing at 0 to 3%, that means the average traditional bank is going to be flat to slightly down. The direct banks, the internet banks, are going to continue growing at a double-digit pace as our baseline forecast this year. With that said, there are lots of ways this could play out. And it's really easy for us to put together scenarios that land a couple points ahead or a couple points behind this plan. Even a really modest change in inflation or wage growth, a difference in when the Fed is able to end quantitative tightening, potential regulatory changes, all have a significant impact on these figures. And so, being able to plan for those scenarios is really important. One of the ways that we think about that is, by running a number of different scenarios, identifying what the biggest drivers of change are, and when would I need to shift strategy. In addition to the macroeconomic and micro drivers, actually one of the other big things is, what are your bank objectives? Are you looking for volume, or are you in more of a kind of cost pressure environment, looking for extra margin? One of the scenarios we always recommend our clients run is, what happens if you're asked to go get more deposits? Commercial fell short of plan, and we need an extra, depending on the size of your institution, we need an extra 50 million, 500 million, 5 billion in deposits by the end of the month or by the end of the quarter. How are you going to do that? And do you have strategies in place that you've already agreed on that you can just go execute? Becomes really, really key to success. So that's number one. We'll now kind of shift gears a little bit and move from forecasting into CD maturities, and similarly start here with what we're seeing in the market and then shift into the essential analytics.
Thanks, Adam. Hi all, this is Ravi Subbaraya. I'm new to Curinos, but I've worked with Curinos over the years. And I think Agusta said it best. Deposits have been a really important business, but and Adam said it's kind of steady Eddie for a while, and it's far from it now, right? In the last couple of years. And if there's one poster child for a product that was out of sight, out of mind, that was CDs. I can't recall when CDs were cool before now, but boy, are they back in fashion, right? And top of mind for banks. And as you can see the trend here, CD balances grew almost a quarter of the industry portfolio, because this has been the primary lever used by banks with aggressive pricing. And that has had outcomes of a lot of liquid balances from checking or savings starting to move into CDs. And you see the trend here and the mix shift on the left side. And balances continue to grow at double-digit rates throughout last year. It did start to slow down a little bit at the end of last year as the Fed signaled a pause in rate increases and everybody started to look for rate cuts. But some of that was again reversed. So it creates a very interesting environment for CDs. What all this growth from the last year, and we'll start to see them mature this year. So it's been pretty much the most important topic for most of our clients, and probably the most popular topic at this time. So now as we get into 2024, as you look at the volume, a lot of that CD mature are starting to mature. And it's a mix of, there's very little 25-month plus CDs left out there. And it's mostly 11 to 24 or 0 to 10 that most banks put last year. So as you can see the curve, there is a very large volume of CDs starting to mature. The 0 to 10 for sure that were put last year at increasingly higher rates. But the bigger challenge could be the 11 to 24 that were put on in an environment of really low rates. And those start to mature as well. And then on the right side, that volume is understated here because as banks and customers look ahead at a falling rate environment, and we'll talk about that a little bit in a slide further down. All those CDs that banks are starting to put on now, they're shorter term, they'll start to mature in the second half of the year. So this volume is going to be pretty high for most of the rest of the year. And another dynamic that you're going to see is that CDs were a pretty loyal following, a small percentage of customers, and they behaved a certain way, and they continued to auto renew over time. But last year, with the increase in rates, whole new segments of customers have bought into CDs. And we know that there's first-time CD renewal behavior is different, and there's going to be a lot of that this year. So it's going to make it quite an interesting environment as all these CDs mature.
Ravi, question came in around what kind of term duration is popular right now. So there's a lot of very high short-term rates, 6 months and sometimes under. Are we seeing anybody having success in longer terms, kind of in that 11 to 24, and particularly the higher end of that?
Yeah, it's a great question. I think there's a few pushes and pulls here, right? So as banks look ahead at a falling rate environment, they like to start shortening the duration of the lockup. Whereas if you go too short on these CDs, they start to compete with liquid balances, and you can see some more liquid balances moving into shorter term CDs because people are willing to take that risk. But the question was around are banks starting with long term? I think the long term, and again, depends on the bank strategy of how long do you want to lock in balances for, especially in a falling rate environment. There will be a cohort of customers that do tend to want to lock in rates because they see the same news as us. However, there's a tendency, and you'll again see this in a falling rate scenario that we'll show in the next page. So it's a bunch of pushes and pulls. The banks are trying to shorten the duration. Some customers want to lock it in. But as rates starts to fall, customers do want to go shorter or go into liquid products. So this chart is showing what we call roll rate, and just to make the definitions clear, a CD, as they all mature, they either try to leave the bank or they auto renew in the same product at a different rate, or they switch into either another CD or a liquid product. So those are the three tiers here. The black is the attrition, blue is the auto renewal, and the light blue is the switch, as we call it, into another CD. As you can see, and to my point earlier, CDs were a fairly predictable business, the predictable segment, and they would typically auto renew. And 67, as recently as January 2022, it was that 67% would auto renew because the rates were fairly stable. But as more and more of the CDs that are coming due, especially 11 to 24 months, the rates that they were booked at and the prevailing rates there's a huge differential. So there is a very high percentage of customers who are starting to wake up and look at renewal options. And typically the auto renewal rate has been compressing, as you can see that curve go down. So banks are offering other CD products for the most part, which is where the switch is going to, with a different mix of durations depending on the strategy of the bank to retain these balances. And that's where you see all of that. Almost 54% of the balance retention is through CDs or through other liquid products in some cases. As Adam said, it depends on the priority of the bank as well, right? What are you constrained on, balance sheet or income statement, right? Especially in a falling rate environment, you're optimizing for interest expense and trying to bring that down. And it's a risk and a bet that you take on to see if you're willing to let go of some balances if they do leave. And then the second part of that is, if you need to turn around and reacquire balances, does that cost you even more? So these are complex challenges. The few other factors to think about is, as I said, if you bring the duration too low, it can start to encourage liquid balances to move in. That's not something that most treasurers or CFOs would want to do at this time. And the last but not the least is the customer perception. Auto renewal rates are typically low, and clearly there's been some concern from customers as they go from a 4 or 5% handle to a sub 1% handle, and what kind of customer risk does that create from a perception, reputational risk, and complaint, and all the rebooking of those CDs. So these are important factors to consider and balance out as you think about how to handle this bubble of CDs coming through. That'll going to be here for a while. So that Brad, I'll ask Brad to jump in and talk about how we can leverage analytics to strategize about at the customer level.
Absolutely, thank you, Ravi. And quite interesting trends that we saw in the last couple of pages, looking at where roll rates have gone, what's going on with attrition. As of yet, we really haven't seen a significant rise. But what's coming next? And so as we think about the essential analytics to better manage your CD maturities, a couple of things to keep in mind here. One, as we think about historical performance on the left-hand side of this chart, we want to know how attrition, switch, and auto roll have been changing over time. We also want to know how they've been changing under different conditions, meaning in the situation where your rates were close to top of market rates, when those CDs mature, so for example, in July of 2023, we see the blue dot pretty close to the red dot, meaning that this institution's rates were close to top of market. We see a lot of CD maturities for that month as expected, but what's the distribution? What's the mix, and how does that change? As we look forward and we think about what's coming next, this particular institution is looking at high maturities in January of 2024 because their rates are right up against the top of the market. When those come into maturity, are we going to see an expected attrition level rise? Are we to see expected switch going up? How does the interplay between your rates and the market affect your ability to hold on to deposits and also hold on to them at the current CD maturity bucket, or if they're switching? So a lot of factors here that you're going to want to look at as far as CD maturities as we move forward. Going beyond the essential analytics there, we also want to think about our next generation essential analytics. So moving beyond the portfolio level and really diving into customer level impacts here. So we're seeing here on the chart a mix between likely to auto renew and likely to switch into different terms. So what's the shopping behavior at the customer level expected in this portfolio? So for those accounts that are likely to auto renew, there's really no additional treatment needed. That's not where we need to spend our time. It's not where we need to necessarily offer different rate plays. But when we look at the bottom right-hand side of the chart, those are areas where they're not likely to auto renew. They're going to be shopping, but they will likely respond to a term switch offer. So they're still likely to stay within a CD. Those are the areas where if we provide a different type of term offer, we may have a better shot at retaining those balances and keeping them on book. And then the third bucket here are ones that are not likely to auto renew, are also not likely to stay in a CD. So for that tranche of accounts, there's no purpose of raising CD rates and pushing up on that side, but maybe we want to put a savings rate out there. Maybe we can retain them in that space. And so based on the dynamics of your customer set, there are a lot of different plays that we can entertain to both maximize our retention number and also minimize our cost.
Ravi or Brad, one other question came in here. Aside from using rate, and I think this page is an interesting illustration of the idea of trying to use rate more in a more targeted fashion, only toward those customers who need it. But have we seen anything other than kind of top of market rates be effective in terms of helping retain CD balances?
Yeah, so I can take that first and definitely talk a little bit about what we're seeing. Unfortunately within the CD space, they tend to be some of the higher rate sensitive customers on book. And so really rate is going to be a predominant factor in that space. However, when you do start unpacking and looking at total relationships, there's a large difference between single service CD holders and the use of rate there versus full relationship plays, where we can see here, there may be a liquid rate where you can step down to that'll be just as effective as putting up a high CD rate. So there are different tactics you can use to try to work the rates down over time.
Yeah, I agree with Brad. I think CDs have been successful in acquiring net new customers, but your challenge is always in terms of, is it hot money or can you retain them through relationship benefits? The only other strategy we've seen is there's an arbitrage of cash offers versus interest expense. So can you attract customers using some kind of cash offer that that's lower than having a customer stay in high interest rate balance? And so those are the only strategies that we've seen.
Yeah, maybe I would add one more, which is allow for some level of runoff and then reacquire later. And so there is a kind of time dimension and, for the larger institutions, a geographic dimension in terms of, again, with the idea of instead of spending your interest expense evenly across every single customer, spending it where it's going to be most effective. And sometimes, that means increasing margin on a tranche of renewing customers, and then bringing in some new to bank dollars over the next couple months.
Yeah, as Adam said, I think we're talking about planning in a changing rate environment, and on top of mind for everybody is there's a falling rate environment. And while we talked about CDs as a big dynamic, there are other dynamics here. So there's a lot going on this chart, so I'll try to do justice to this. And this is our experience that we charted out from the previous flat rate and falling rate cycle from November 18 to February 20. And I'll caution everyone, as you know, that was at a different scale in the sense that if you look at it, the highest rate that ever was at 2.5%, not 5%. So the past is not a full predictor of the future, but this starts to give you some indication of dynamics of both what banks and customers do. So as you see in this chart, the red curve is the Fed curve. So rates flatten out and stay at flat for about a bit, and after that they start to go down. And we're in that plateau period at this time. So put your the same scenario in current terms. So what we saw early on was banks competitively and somewhat customers start to shift to shorter term CDs. So that's the first dynamic that you see. And then at some point, somewhere near the end of the plateau, some customers will lock in CDs. So you do see a boost in CD acquisition because some customers want to lock in a longer rate as they're hearing about the rates go down. But there is also a parallel dynamic of increasing term switch to liquid. And there are multiple dimensions for that. One's customers not wanting to lock in, banks not offering terms and conditions that are more favorable and leaning towards liquid products, and perhaps economic conditions that are underlying the rate decreases as well. It's where customers need the liquidity. So all of these different factors go into the tag end of the plateau period. And peak CD rates, interestingly, hit when the rates start to decline, as you can see in that graphic there. So the question, are we there yet? Right now, we're in a plateau solidly, but we haven't seen the rates decline. Will it be May? I mean, it's a good anybody's bet. So we haven't hit peak CD rates yet, portfolio rates. And that's also because all the acquisition that's coming in at a much higher rate. So the portfolio is remixing and continues to go up. And that's the other reason there. And finally, in this, the term versus savings premium changes over time. And we'll see another chart on the next page on this. And stay as rates then fall and hit a plateau, savings growth come back to start growing again versus CDs. So continue on that theme, as you look at the flat rate to the falling rate, there are two pieces of information on the slide. One is the term versus savings premium. So as you can see in a flat rate, the term versus savings premium is pretty high, and CD, and as we hit a falling rate environment, that changes, right? The premium stops, and then savings continue to fall and share through the flat rate, and then start to pick up in terms of percent of acquisition in a falling rate environment. And finally, continuing on that theme, the switch to liquid versus switch to term, again, charting with the Fed rate cycle here. The black graph is the percentage switch to liquid that will start to spike up as the rates start to drop. And then the percentage liquid switch to CD starts to go down. But again, this is all about looking ahead, being prepared for these various scenarios. There's no certainty here. And the other key takeaway I would have is that be prepared for these various scenarios, and your organization's ability to test and learn and pivot these strategies as these different scenarios pan out, I think is key to success here going forward.
So as we move into the essential analytics of navigating a changing rate environment, one of the pieces that's really critical is understanding flow of funds in your portfolio. So Ravi touched on a number of key factors in the portfolio remixing, what we would expect to happen moving forward. Looking at an example here on the page, this is looking at checking account balances in the rising rate or the elevated rate environment. We'll see in this particular example, checking balances declined from that starting balance to the ending balance point. But one of the hypotheses that we heard from some clients was, hey, it looks like I'm running off my checking portfolio. Am I still seeing healthy household growth? Am I still seeing core depositors attracted to my bank? Should I be worried about this? And when you unpack things by the flow of funds level, you can see for this particular institution that most of the balances that ran off were in what we call the change to existing, which means the balances drew down, but the accounts were not being closed. So these are people that are redeploying that surge deposit, the excess liquidity on their own accounts. They bought that item they might have waited 2 years to spend on. They were either caught up in inflation. You know, Adam showed some views earlier in the presentation about, you know, what drove balances down at both low average balance and high average balance accounts. So a lot of that is picked up here. So what's driving checking balances down isn't that people are attriting. You can see that bucket to the right is the smallest outflow bucket in the chart. And so there isn't really that concern or alert here that we've got, you know, a developing red flag, you know, with this particular portfolio. What's important to be able to do here is to say, so as the rate environment reverts, as potentially we see the environment come back down, am I getting my fair share of deposits parking back at my transaction account, which you'd expect in a falling rate environment? And conversely, if I'm looking at my CD portfolio and not this checking book, if I start to see acquisition levels coming down, which you'd expect, am I seeing balances switching out? So meaning they're still staying with the bank, but not necessarily in the CD, or am I seeing attrition? So balances are actually running off and maybe I'm going to develop a funding challenge. So it's really important to understand flow of funds, to know if I'm getting new accounts and new money, to know if I'm getting, you know, switching internally, or to know if I'm seeing attrition, which could be obviously a sign of being non-competitive in the marketplace.
Good question coming in here on the flows that Agusta,
Sure.
you might be best positioned to answer around the complexity of CD flows with grace periods and early withdrawals. You know, how do we think about measuring flows on CDs, kind of given some of those different dynamics?
Yeah, that's a great question. And we've had a lot of practice figuring that out because it is complicated. So because there are grace periods within CDs, so a customer can change their decision, maybe the CD will auto renew at the end of the maturity cycle, and they typically have in the order of 7 to 10 days the ability to get out of that auto renewed CD option and either pull their money out of the institution as attrition or switch to a different product. That makes it really complicated to track sort of what's happening to that CD at maturity. So within our analytics, what we're doing is we'll do a look back. So we'll calculate the initial flows to understand, okay, this customer, it looks like they auto renewed, but then the next time we get data, whether that's the next week or the next month, we're going to look back at the maturity event and our most recent data to say, okay, let's do a check against that grace period. Did they actually stay in that auto renew CD, or did they make a different decision? So we're going back and correcting for any changes of heart that might have happened during that grace period. So we get a really crisp, clear, accurate view of CD retention that tends to give us the best understanding of customer behavior, which then gives us the best sort of elasticity models to understand how much does rate really impact CD maturities.
Thank you, Agusta. And as we continue on, as we dive down deeper into that customer level segment, what we're seeing here is it's also important to understand the different behaviors by different types of customers. So for example, you may have brought in a number of CDs via chronic shoppers. Those are customers who are absolutely rate driven. They move balances whenever their promo's over, wherever that CD comes in to mature, they're going to reshop for the highest rate in the market. That's in contrast to situational shoppers, where we're talking about people who are definitely rate sensitive, but they will not shop at every moment. They're going to wait for certain life moments. Their bonus check comes in, a tax refund season, which we're in right now, or windfall events that really make them think about their banking relationships. Those are folks where you can potentially bring in a high amount of deposits, but you may be able to keep them too at rates below, those top of the market rates where the chronic shoppers will require. So there's a number of different ways to think about your book when unpacking it at these levels. What's the right rate response and what's the right tactic to use to both retain these deposits and attract these deposits going forward? especially as we see the market start to revert down to a slightly lower rate level.
Well, one other question came in, Brad, which I may take this one myself actually, which is how has the industry progressed towards customer level deposit pricing, and are we seeing that become more prevalent? It's a fascinating question and one that we're eagerly looking at. I would say the answer so far is it's less about customer level pricing and more about customer level targeting, communication, marketing, and offers. Banks don't, by and large, have the capabilities to manage the complexity of 15 different price points in a single product. You'd also get diminishing returns at that point of, how different really are they? But are there some customers who are much more willing to, are much more likely to respond to a CD offer versus a savings offer? Are there some customers who need an absolute top of market offer while others just need a competitive offer? So I think number one is figuring out who's who from a customer perspective and how you segment them towards the right offers. An equally large driver, and one that involves much less complexity though, is more customer level messaging. This is kind of the Amazon prompts, right? Of Amazon always seems to know exactly what you're thinking and what kind of messaging is going to appeal to you. In a multi-channel world, giving it may be the same product and the same rate, but how you position it to Brad versus Ravi versus Agusta may make a huge difference in terms of how they take it up. And so can you give them the right message and the right communication around that offer that's going to make the acceptance of that offer a lot more likely, is typically a lot easier to implement, and where a lot of the innovation is happening. But this is definitely the direction the industry is going. It's where most other industries have gone, is to greater levels of segmentation in terms of pricing. It's more complicated in financial services given the regulatory environment than it is in other places, but we're definitely moving that direction.
Adam, I can add a couple more perspectives from a practitioner of this in the conversations we've seen. You hit the nail on the head. The complexity of execution and the ability and capabilities banks have, whether it is if the customer calls and the care center is answering the question of what's my rate and why is it versus my neighbors, my friend just told me this, right? So there's a fundamental complexity that is involved there. The other is just even the cores, the pointers that are available in systems to be able to manage that is hard. And last but not the least, you mentioned the regulated environment. You have the other push and pull of all customers should get the same rate because it's fair, or it is, and the dreaded word of UDAP or something can come up. So these are all pushes and pulls of the analytical side of customer level pricing, targeting, and messaging is much further along than the execution capabilities from a platform and operations perspective.
So that leads us to our final section today is how Curinos can help. We know we presented a number of different challenges in the marketplace today, a number of different ways that you can attack those challenges. We here at Curinos are ready to help. We do that through 4 different primary components. We have a wide variety of intelligent data. So some of the rate and fee shopping information across the deposit and lending landscape. We've got strategic comparative analytics. So this is information allowing you to compare your performance to market, not at the high level, but really down at the level of granularity that you make decisions, which is a critical component of that piece, as well as optimization platforms. So when you're thinking about different rate trade-offs, you're thinking about different product decisions, how might that impact your portfolio? How do I think about a 3% Fed environment versus a 4% Fed environment? How does that inform my decisions going forward? And layered across all of that is the strategic advice to say, I'm considering doing something different than I have before. what kind of intelligence can we bring into that equation? Who can we talk to that can help shed some light on what strategies may have worked in the past? So by leveraging all 4 of those components enables you to succeed, especially in an environment like 2024, where not only do we expect a falling rate environment, but we also expect uncertainty. There's no shortage of variables, I think, that are ahead of us over the next 12 months in particular. And so with that in mind, on the last page, we'd love to talk to you. We're ready to help you succeed in this space. Highly encourage you to schedule a session with us today. I put my information down there. Hope that you reach out, let us know how we can help. We'll set you up with the right folks to talk to, and absolutely want to hear from you, hear your questions, anything you may not have asked during the session today, on other support that you may need. So whether you're our credit union friends, our community banks, mid-sized banks, and nationals, we definitely want to hear from you and are ready to help. So definitely appreciate everybody's time today. It was really great to hear some great questions, and look forward to talking.
Thanks so much, Brad. And with that, we must conclude today's program. The session has been recorded and will be available within 1 to 2 business days. On behalf of CBA, thank you again to all of our speakers and, of course, today's participants. Have a great afternoon, and you may now disconnect.